One thing is clear, Todd, a more diversified portfolio generally has done better than just owning, the Mag 7 is underperformed, the more diversified portfolio is doing a little bit better. I mean, TCAF, TCAF, or the first one we discussed, is actually doing reasonably well this year.
I think we finally reached the point in the cycle where overweighting the Mag 7, all of them, right, hit its limit. And it made sense to finally diversify away from those names. Not necessarily go to zero, but water it down a little bit, or maybe go overweight one name and underweight the rest of the names. And you're seeing that internationally too. International stocks, especially European, are outperforming. So diversification is finally coming back after not mattering for quite some time. And the beauty of ETFs is, whether it's T-Row or any other issue out there, they likely have a solution that can get you there and at least manage the volatility that's going on.
Yeah, one of the things, the viewers love dividends. I mean, it's astonishing, we've been talking about this for 2 years, how sticky people are with their money market accounts, and they just love the 6 trillion, 7 trillion in money markets, and they're getting 4% and they're very happy. So there's a lot of interest in any kind of dividend payments. People want to own stocks, but they want dividends. You have a dividend growth ETF, has names, they track just a record of dividend increases. It's that simple, right? I see Apple on it, I see Visa on it, JP Morgan, I see Chubb, I see GE. It's an interesting amalgam, all tied together. There's your big names here, Apple, but you see Visa to JP Morgan, Chubb, GE. And we see big inflows into this, some of these recently as well.
Yeah, the dividend growth ETF that we offered was one of the first products that we launched back in 2020. And we have seen significant growth, as you mentioned. I think as a macro theme, income and dividend payment continues to see strong inflows across the ETF industry. For this fund, as you mentioned, there's kind of two things. Number one is dividend payment and income, but also longer term capital appreciation. So you do see that element.
Yeah. So there's two elements to this.
There's two elements to this.
And we have to point this out. There's 50 different dividend ETFs that are out there. We have to explain this because people get confused. They're not all the same.
So having an active strategy then is kind of a differentiating point, because most of the dividend ETFs are passive, and they're saying, all right, we're going to be the 10 or the 100 largest names growing their dividend, or the 100 largest dividend yielders, right? So having an active strategy, you're getting the dividend, and then you're also getting kind of a quality characteristic involved too, because the managers should know the stocks.
Yeah, so here's the difference. You can buy an ETF that just has the highest dividend payers on a percentage basis, which generally is not a good idea. We've said this for many years, because that could be in danger of cutting the dividends. For example, oil stocks. Then you have ones that have a consistent history of paying dividend increases, which is sort of what you're doing here, but you also have an overlay of capital appreciation too on top of that, right?
Right.
So there's sort of two elements here to this.
Yeah, there's two components, and I would go back to, I think, the differentiator for T. Rowe Price, and there's, I would say only a few firms that have the research capability that we have globally, and that bottom-up fundamental research actually drives investment decisions across our lineup of portfolio, and the ETF
and
side as well.
What is the yield right now? Which I'm sorry to put you on the spot. I actually don't know, but it's probably 1.8, 1.9, probably close to 2%,
I'd have to double
somewhere
check,
right in that area. Yeah, it's tough to have a big bond fund that actually has a significant yield, unless you go into stuff that is, you're practically in high yield space. Where you're dealing with companies that are just historically paying a high yield in general. Can you explain why you don't want to do that? Because people message me all the time, just send me the top 10, that have the highest dividend yield on a percentage basis. Why that's dangerous.
So there's a credit problem. I'm not saying we have a credit problem right now, but you've seen spreads widen. Corporate spreads have widened, CDS spreads have widened. Some of the funds that are credit sensitive, like CLOs and high yield and whatnot, have started to see outflows, and there were some discounts recently during the market stress. So you don't necessarily want to go super high yield when the credit backdrop in corporate America deteriorates. So now we're getting to that tricky part of the cycle where the stuff that really worked and was great is not exactly doing the same thing anymore.
Not to hold your hand, but the real problem here is among those that are the highest dividend yields, there's a danger that the dividend could be cut, right? So for example, for years ago when oil stocks were all in the highest dividend payers, there was a real worry out there that they were going to cut the yield here if the cash flow gets into trouble. It's all of a sudden the oil business sort of drops dramatically. Then we had to have Exxon come on, could Chevron come on and say, no, we are not cutting our dividend. Everybody calm down. This was several years ago, but they were on the highest dividend, so that's the risk right there.
Yeah, and again, I think that's where active management comes into play, where you're able to more nimbly navigate markets, especially as you see increased volatility and even dispersion of stock return within sectors or across industries. So, yeah, I couldn't agree more. And I think that's the benefit. And if you look at passive products, there is more static holdings there, right? So if you do see that change in momentum or the overall stock environment, then that actually, they can't do anything about that until there's rebalance time.
Yeah. I want to move on to about actively managed bond ETFs because a lot of interest here. You have an actively managed bond ETF. This holds a very wide variety of, the bond world is very big, folks. It's not just treasuries. I know people love their money market funds, but those are treasuries for the most part. But this fund will hold treasuries, it'll hold corporate bonds, it'll hold mortgage-backed securities, very significant part of most of these diversified bond funds. Can you give us sort of broad thinking on what the idea is for bond holdings right now?
Yeah, the ticker is TAGG, and that is a core holding. And we're seeing a lot of different clients from different segments who are kind of replacing in using TAG as a more thoughtful way to gain their exposure to the core bond market. So this fund is really designed to provide greater total return than the Bloomberg US investment grade bond market index. It's also priced at 8 basis points, so it's very competitively priced.
Yeah, active bond funds are typically what, 20 basis points?
Yeah, I mean,
25?
You're basically getting a professionally managed fund for nearly free.
Well, you're getting it for index prices. So you're getting an active fund for almost an index price, essentially.
I do think it's interesting. We've reached this point, 2 inflection points of peak concentration risk on the equity side and peak credit calmness on the fixed income side. And so now this is where active managers on both ledgers, right, fixed income and equity, can really shine and say, all right, we know where to move on the fixed income curve, on the credit quality curve, because things are rapidly changing by the day in this environment. Things that have worked are no longer working, and it's really quickly changing. I think that's where the ETF solution comes in hand, and having the active approach is really going to work now.
Yeah, the active bond fund managers have been coming on recently and saying this is when we're really good here. Now, we're used to active equity people coming on when market's volatile saying, well, we're finally going to justify our fees here, we're going to outperform, and as you know, it's very hard to actually do that. The long-term track record is very tough for active. But active bond fund managers have been claiming they can do a little bit better than active equity. Is there any, you follow this stuff, is there any evidence that active bonds might do a little better than active equity in a volatile market, and why would that be so?
Depending on the report card you read, I think there is some evidence of it, and depending on where the focus of that fund is, right, if it's long duration or go anywhere, right, I think the go anywhere funds can definitely do better because they can go out into different esoteric areas. But it probably depends on the report card, to be honest.
Yeah.
But in this environment, long duration doesn't work. And so if you've been in long duration, you've been having problems if you're passive. And so if it's an active manager, they know they haven't wanted to be out too far in the curve. And they've been sitting in that high quality corporate type stuff. Maybe now they can start to edge out in the curve if things are really going to deteriorate in the economy.
Let me ask you to put on your ETF hat here, looking out for this year. Any thoughts on where we go? We sort of hit on active in a generic way. Any thoughts on other developments that you might see that might impact the markets or the ETF business?
Yeah, I think we're actually really early days in terms of active management and the uptake. And if you look at some industry projections of where active ETFs go from here, as you mentioned, we just crossed $1 trillion in AUM. There's projections out there that this will be a $4 trillion plus market by 2030. So I think you're going to see a continuous launching of more active products. And just statistically speaking, over the last 3 years, active ETFs have made up about 65% of all U.S. ETFs listed in the U.S., and I don't see that slowing down. I actually think that's going to
Any new products out there? I mean, Bitcoin was a huge success last year. It sort of leveled off at this particular year. Gold's had some inflows. I don't know what else out there is intriguing for T. Rowe Price.
I mean, as we're looking across our existing product suite, we have 19 products in market, over 13 billion in AUM, and that's quickly growing. We also have very aggressive plans to expand our product suite and offering both across fixed income and equity products, including some additions to international equity, et cetera. So I think you're going to see, continued innovation more broadly. As you mentioned, digital assets. You could see more innovation coming around that front as well.
Well, certainly more volatility is good for active at this point. As a long-term investor, I'm perfectly happy with lower volatility myself, but it's good for you guys. So congratulations, and thank you for coming, Tim.
Thank
you,
Bob.
Appreciate it.
Thank you.
That does it for this week's ETF Edge. My thanks to Tim and Todd. We've asked Todd to stick around and give us his perspective on ETF flows in this chaotic month. That's coming up on the ETF Edge podcast. And remember, you can see all of our shows on our website. That's etfedge.cnbc.com. Everybody have a healthy, happy, and safe trading week.